Evergrande, China's second largest real estate developer, has just been ordered to liquidate by a court in Hong Kong. In other words, die and sell its assets to try and reimburse debt holders. Although equity investors will probably see nothing because there's already not enough to satisfy bondholders. This entire situation is complicated, and really Evergrande is just a symptom in a much larger and dangerous problem in China. So let's talk about Evergrande and what this liquidation means, but let's also talk about the much broader, dangerous real estate crisis as a whole that's currently unfolding in China. Because if there's going to be risk of contagion, it's going to be because of that. So let's talk about it. Now, Evergrande has been at this for years. Their problem started back in 2020 and they filed for bankruptcy last year. But bankruptcy doesn't mean liquidation like what's happening now. Bankruptcy is a form of protection to perhaps come up with some sort of restructuring plan that will make debt holders happy. That is much different than what just happened now. A Hong Kong court has ordered liquidation of Evergrande, which is effectively the death of the company. Now, it is yet to be seen if mainland China will go along with this. Remember, China has a two-system structure where Hong Kong is more capitalist and the rest of the country is more state-owned, or at least state-controlled. And there's one little problem with that. 90% of Evergrande's assets are in mainland China, which means that if anyone, debt holders or investors, want any chance at being repaid, they're going to need access to those mainland assets. Now, let's talk about those assets and liabilities because the picture here is not pretty. Evergrande has about $240 billion in assets, but it has over $330 billion in liabilities. That picture, for lack of a better term, sucks for equity investors. And honestly, equity investors are probably going to lose everything invested. It also doesn't really paint a rosy picture for bondholders. With that said though, not all the $330 billion in liabilities are bonds. About $85 billion is in accounts payable, so supplies, payroll, etc. And about $87 billion are contract liabilities. These are basically unfinished developments that were pre-sold to the public. And then the remaining 90 or so billion is true debt in the sense that we think of. But here's where it gets interesting. About $150 billion of assets are actually in the form of unfinished developments sitting on Evergrande's books. This is one of the main reasons why they've had liquidity problems in the first place. And that means right off the bat, a huge portion of assets are going to be hard to sell or slow to sell to use to repay bondholders and maybe investors. Now, the liquidating process will likely try to sell these assets to other developers to recoup some cash. Now, all of this is a big if, and that if is if China actually recognizes the authority of liquidators to access mainland China assets. And this is where it gets even more interesting. Foreign creditors are owed a little over $25 billion. So basically everyone is watching how these foreign creditors will be treated by China. Will mainland China favor domestic creditors first or foreign creditors first? And really it's kind of a catch-22 situation for China. On one hand, they could favor domestic creditors and show the rest of the world that foreign creditors are secondary. This could cause less foreign investment in China in the future. And on the flip side, if it instead favors foreign creditors, then its own domestic creditors will suffer. And again, that's assuming that mainland China goes along with the liquidation in the first place. In either case, Evergrande is pretty much fucked. But Evergrande is kind of like a cough in a much broader illness affecting the Chinese real estate sector. So let's talk about that illness and then let's answer the most important question. Is it contagious and will the rest of the world catch it? And that illness is what can only be called a crisis in the Chinese real estate sector. And the main reason that this is so concerning is that in China, real estate acts like the stock market does in the United States, as in a major driver of wealth building and the primary place that Chinese citizens invest their money. In fact, nearly 70% of all Chinese household wealth is in real estate, which means a slump in the real estate sector will hurt other sectors as well. And this really can be attributed as one of the main reasons that China is facing deflation when the rest of the world is facing inflation. And deflation, believe it or not, is much worse than inflation. So how did this even happen in the first place? 3 red lines and overbuilding. The 3 red lines policy was, and is, a regulation aimed at curbing overborrowing by real estate developers. Basically, 3 red lines in the form of 3 ratios: debt to cash, debt to assets, and debt to equity, that, if crossed, limit the company's ability to borrow more debt. The problem? Evergrande, as well as many other major real estate developers, were already way past one or more of the 3 lines the moment it was implemented. Pop quiz: what happens when a way over-leveraged company is cut off from the funding it needs to build the next round of developments it needs to sell to be able to build the next round of developments? It implodes. And this is exactly what happened to Evergrande, along with other real estate developers that make up 40% of all home sales in China. And on top of that, overbuilding. Overbuilding has led to the exact opposite problem that we're facing in the United States, and that is too much supply and not enough demand. And one of the main reasons for this is that unemployment is very high, especially in the youth sector, the sector that is kind of required to buy the next round of real estate to keep this whole system moving. Youth unemployment hit 20% in June. Now, China did announce a new 14.9% unemployment rate using a revised formula. Whatever. Either way, that number is really bad, and what it means for real estate is falling prices, which means that the development projects, which are assets to companies like Evergrande and dozens of other real estate developers like Country Garden, are worth much less. So lack of funding and lack of buyers and overbuilding led to lower prices. And boom, you end up with a major wealth-destroying real estate crisis in China. But the real question for most of you watching: does this matter for the rest of the world? Well, yes and no. The immediate risk of contagion is not present. The Chinese real estate sector is much less globally exposed, and foreign investment into the sector only amounts to a few $100 billion. So direct contagion? No, but indirect contagion is much higher of a risk. You see, the same banks that lend to the Chinese real estate sector also lend to businesses in other sectors which are much more globally connected. So if there's a major liquidity shortage, in other words, if losses pile up at these shadow banks, then that does carry a contagion risk. But hold up. What are shadow banks? Well, these are basically investment firms that do create liquidity, but they don't do it officially as a bank. So instead of getting funding from depositors or creating bank balances, they get funding from investors and then lend that money out. And China has a ton of loans tied to these types of banks. In fact, it's about 40% of all funding activity. Anyways, if losses pile up at these shadow banks, funding for other businesses in other globally connected sectors could dry up. And in fact, that's already happening. Zhangzi Enterprise Group, one of China's largest shadow banks, declared itself insolvent in November after missing payments on dozens of its investment products. And please forgive me if I butchered that name. Anyways, Moody's, the rating agency, actually downgraded its outlook on China's credit rating from stable to negative in December precisely because of this risk. But with all of that said, let's be clear right now. This is not some 2008 Lehman Brothers moment. This is a regional crisis in a singular, highly domestic sector in the Chinese real estate market. But there is some risk of contagion, though it's once removed through secondary sectors not directly tied to Chinese real estate. And even then, the risk of contagion is low. I think the much greater risk that we should all be paying attention to is the direct impact that this has on China's GDP and economic growth. The current Chinese real estate market is the single largest drag on the Chinese economy, and China is a major world economy, second only to the United States. So as they say, when the United States coughs, the rest of the world gets a cold. Well, it might not be as severe as that, but when China coughs, the rest of the world also coughs. AKA, when China's economy slows down, so can the rest of the world's. And that is the real risk. So while I don't expect some Lehman Brothers type of collapse, I do think this is something that we should pay attention to and not shrug off as just something that's happening thousands of miles away from us. I hope this video was informative, and I hope it brought perspective into a subject that I'm sure is going to be sensationalized in the weeks to come. Yes, it is a serious issue, but no, it's probably not the start of the next financial crisis. Famous last words. Other than that, I hope you have a fantastic rest of your day. If you haven't subscribed, please consider doing so. It helps out the channel tremendously, and I will see you in the next video.